What really wears you down in this market isn't the price going up or down, it's that you can clearly see risk hasn't gone away, but prices keep climbing, and sentiment keeps recovering. You can feel a force pushing forward, but it doesn't feel like a natural trend. It feels more like a forced, passive stalemate. Hey everyone, I'm Peter. Today is January 13th, 2026. We're not talking direction or predictions today. I want to make one thing clear up front. This isn't a market where you make money by calling direction. It's a market forcing every participant to slow down. If you feel like trading's become sluggish or the rhythm feels off, that's not a technical issue. It's the market pushing everyone into defense mode. Yesterday's U.S. session was a textbook stress test for sentiment. Trump publicly attacked Powell in the media, questioning the Fed's motives. At the same time, the Middle East flared up again, oil surged pre-market, and risk-off sentiment picked up. The expectation was a major drop, but once the session opened, the indexes gapped down and quickly reversed higher. All three major indexes turned green, with small caps IWM leading the charge. What does that tell us? It's not that the bad news doesn't matter, it's that the market is testing whether it can still withstand uncertainty. In this kind of market, people often think the bad news is priced in, so the risk is gone. But here's the truth. This isn't numbness. It's restraint. What we're seeing is hesitation. The news drops, and everyone waits to see who'll move first. It looks calm on the surface, but everyone's holding tension like a stretched wire. If something triggers the move, all that suppressed emotion can unwind fast. Technically, the S&P 500 is still moving within its upward channel, but it's in the latter phase. We're now less than 2% from the 7,000 level. And that's no longer just a psychological milestone. It's a structural battleground. If the index breaks through and accelerates, the bull market could enter a new phase. But if it stalls here and we get even a small policy or external shock, it could activate a wave of Court A and algo-driven de-risking. That would flip leverage the other way and fast. This is where a common mistake happens. People equate no drop with no danger. But real systemic risk doesn't show up in price first. It shows up when everyone's guard slowly drops. Right now, we're in a zone where valuation and sentiment have both been stretched. That means even small variables can trigger chain reactions inside the system. The biggest systemic risk right now isn't CPI. It's not the growth outlook. It's a creeping breakdown in trust. The Fed's independence has been the backbone of dollar-based asset allocation for decades. But since late last year, Powell's political interference, legal scrutiny, and mixed policy signals have started to chip away at that trust. It's not just about the credibility of the next rate path, it's about whether U.S. assets can still function as the global pricing anchor. You need to understand what's shifting here. It's the market's faith in the rulebook. Many are still analyzing CPI payrolls or GDP the way we always have, but those numbers aren't enough anymore. They can't explain how the market is pricing things because the foundation the pricing sits on is no longer as solid. Markets are worst at dealing with unquantifiable risks. You can't plug them into a model like you do inflation or jobs. They don't have a defined probability, there's no playbook. So what does capital do? It widens safety margins, trims position sizes, and demands more risk premium. This doesn't cause a crash, but it makes markets hypersensitive to even minor bad news. One headline, one rumor, and you get an exaggerated reaction. That's the danger. Not obvious losses, but quietly stacking tail risk without realizing it. What you really need to watch out for is precedent. If the market starts to accept that monetary policy can be politically manipulated, if judicial interference becomes normal, if rules start looking optional, then our old belief that dollar assets equal safe assets, that starts to erode. This isn't conspiracy talk, it's a fundamental rethink of what we price as risk-free. And the commodity markets are already showing it. Oil is no longer just about OPEC plus or global demand growth. Now it's about war risks, shipping route disruptions, and sovereign unpredictability. Gold and silver aren't just inflation hedges anymore. They're hedging against breakdowns in monetary credibility. That's why, even during index rebalancing or quarterly fund rotations, precious metals have held key levels. This isn't short-term speculation, it's real location under uncertainty. Some are calling gold's recent run the start of a bull market. I think it's too early for that. Right now, precious metals don't have acceleration momentum, but they do have anchoring power. You don't buy them to watch them pump every day. You hold them so they're there when things go sideways. Think of them as systemic insurance, something you hope to never use, but can afford not to carry. Back to equities, and here things get even more nuanced. We haven't seen a full-scale exit from stocks, volume hasn't dried up, but the structure is tightening. Capital is flooding into a narrower set of names: NVDA, AVGO, MSFT, GOOGL. These are the AI, cloud infra, and high cash flow plays. They're the only pockets consistently getting inflows. And no, it doesn't mean these stocks are hot. It means capital is clustering around what's already been proven. That detail matters. When the market only wants the stocks that can't be sold, that's not optimism, it's fear. Real risk-on sentiment means stepping into uncertainty. What we're seeing now is capital hiding from it. And while this type of clustering can push indexes higher in the short term, it also sets up systemic pullback risk if anything cracks. From the Cord A and systematic fund view, this market is dangerously asymmetric. Most models ramped up long exposure during the slow climb from late last year. That front-loaded the upside and left a bigger vacuum below. It looks stable, but all it takes is one reversal trigger to set off a wave of profit-taking, stop-loss hits, or full-blown reversals. That's structural fragility, not confidence. So if you're wondering why making money feels harder and trading feels heavier, it's not you, it's the structure. Most capital is in defense mode. Everyone's on the same trade, in the same names, following the same narrative. What breaks this isn't bad news, it's broken consensus. Take a step back, and what you'll see is a classic compression phase. Macro data's not bad, fundamentals haven't cracked, but the rhythm has changed. This isn't the same trend structure. We used to have sentiment leading fundamentals. Now fundamentals are forced to justify sentiment. We used to break out, then retrace. Now we test every move over and over again. What the market is testing now isn't your vision, it's your patience. This is a stage where mistakes are easy and wins are rare. If you chase every move, you'll likely get shaken out, even if your thesis is right. But if you reduce frequency and wait for structural confirmation, you'll stay in the game longer, and that's what matters. Technically, the S&P is still within its channel, but 7,000 has become a true congestion zone. It's not just a round number. It's where valuation pressure, maxed out positioning, sentiment saturation, and policy uncertainty all meet. In this zone, good news gets discounted. Bad news gets amplified. This isn't about running out of steam, it's about each next leg costing more. And when markets stall up here without direction, they don't kill prices, they wear out confidence. I've seen a lot of people treating 7,000 like a finish line, get there, exit the trade, flip short. But markets never give you clean endings at the levels everyone's watching. The real question isn't, are we there yet? It's, can the market absorb any more uncertainty once we are? The dollar's recent drop isn't just about interest rate bets being repriced, it's about long-term capital rethinking the dollar's absolute safety status. As Fed credibility wavers, policy shifts constantly, and geopolitical risk grows, quiet de-dollarization models are creeping back in. That doesn't mean the dollar loses its role overnight, but it does mean major portfolios are building backup plans. So here's where everything leads. This isn't about whether you should stay long, it's about whether you can handle being wrong. The best strategy now: slow your roll. Reduce exposure to missteps. I'm Peter. Thanks for watching. If this was helpful, hit like, subscribe, and share. See you next time.